evening, traders from across the globe, and welcome to the 1433rd installment of these educational videos. These videos are geared to teach you the art of technical analysis, and I am very good at that. I am the chart whisperer, and I can teach you how to read these charts. That's valuable information for teaching yourselves how to trade properly. Traders, as we know, this game is extremely risky. Futures trading is extremely risky, causes substantial financial loss, is not suitable for all traders. Volatility has been through the roof. Know that a stop in this industry can be your absolute best friend. If you freeze when you're in a position, your stop is not human. It will get you out no matter what you're thinking about. Put your stops in, put them in first. All right, traders, so what is on the board for trading on Freaky Friday? That would be February 5th, 2016. Why is it Freaky Friday? Do you ever trade gold on Fridays? It is Freaky Friday when you try and trade gold, but we're not afraid of that. In fact, gold is one of the topics on our board. So this video is coming at you on a Thursday night for trading on Friday, maybe through Sunday. We'll see how it goes. That is for the 5th. Traders, we're starting off with what I like to call a neutral stance. We're starting the day off with a neutral omni. We have done that for the last couple of days, and I'll tell you what, it's working really well. We're starting off neutral and then attacking the market as we see fit, using the exact omni that we have, but starting the day off neutral. So it's sort of a hit-and-run approach, and that hit-and-run approach has been working well. We try to make our points, sidestep the markets. The volatility is so grand that if you get yours, if you will, and you get a good trade out of it, sidestep it and wait for the next day. It's been working for us. If you're following me at livewithoscar.com in my live trading room, you'll see we've been killing these markets lately, baby. Right after that video where I yelled at you people for quitting, we have been raking in the points. You missed out. All right, so what's on the board? We're starting off with a neutral approach, but I'll tell you right now, I'm willing to sell big rallies in the emini, S&P, NASDAQ, Russell tomorrow. Nothing small. It's got to be a big rally to get Omni interested. We're playing follow the leader, traders. The indices are playing follow the leader. Does anybody know which market? Not all the time, but if you had to have a generalized rule, does anybody know which market is generally the leader of U.S. indices? Anyone out there?
Dow trading.
Dow Jones Transportation Average. Very good there, Mike Dono. The Dow Jones Transportation Average is the leader of U.S. indices. Again, does it lead every single day, every week? No. But generally, it tells you where the other markets will go. That is the Dow Transportation Average. And let me explain. All right, so the Dow Transports. And here's what's going on with the Dow Transports. If you own a factory, you're going to create a product, one of the goods or services that we have in this country, and it's a consumer-driven economy, the USA. So goods and services are what we are all about. Why? Because Americans, we like to buy crap, put it in our houses, look at it for 3 weeks, throw that crap out, go back to the store and buy new crap because the old crap didn't look good to us anymore, so we wanted new crap. We buy disposable, everything from diapers to cups to everything, you name it, we buy it, we throw it out, we buy more. Go USA, baby, use up the resources, you know what I'm saying? But that's how we are. I didn't create this stuff, I'm just part of it, right? So we are a consumer-driven economy. If you have a factory and you create a product, you need transportation to get raw materials to your factory. Then you need to build your product. People have to get in their cars and or transport in some way, commute to your factory to help you build your product. Then once your product's built, you've got to use transportation to get it out to market. Once it's out to market, we've got to get in our cars and transport ourselves to get to that store to buy it. Transportation happens at every single aspect of creating a product and selling it. If the transportation of those products is slowing down, everything is slowing down. You get that? If the transportation is telling you we're not moving stuff as rapidly as we used to, we're not moving stuff as rapidly as we used to. Now make me the owner of the company. And I start going, hey, we're not moving stuff as rapidly as we used to. Well, I am the Dow Jones Transportation Average. I represent the owners of companies. Do you get it? Is that clear? I hope in layman's terms I've explained to you a little teeny piece of the Dow theory. There's much, much more, but that's a little teeny piece of it. So, the transportation average is deemed the leader. Again, not always, but in most cases, it will lead us around. The leader has dropped itself below the 200-ball moving average. The 200-ball moving average, all the fund managers on this planet use. They key off of it, right? It's very visual. It gets used by so many fund managers. If the leader has gotten down below that average, its followers are likely to follow it down. That's why I say we are playing follow the leader right now. The leader has dropped, and it looks like the followers will have to continue. Will they go down every day? Maybe they'll go up tomorrow, but that's not a trend. The trend lately is the leader is taking us down. So I'll show you the charts to prove that. Next, the bonds are completely erasing the rate hike. Erasing it. What does that mean? If you don't know how that works, just look at a teeter-totter. You're in a park right now, right? Here's a seesaw, teeter-totter, whatever you want to call it. You put interest rates, the big fat kid in the room, you put him on this side of the teeter-totter, and you put the bond market on that side. If rates go down, the bond market goes up. If rates go up, where's the bond market supposed to go?
Down.
Down. But rates did go up. And the bond market went up instead. What does that mean? If this went up, where did rates go? Down. You get it? This is simple stuff. So, the bond market, which I'll show you a chart of in a moment, has basically erased the quarter-point rate hike that the Fed leased on us. Now, another thing about rate hikes. Before the crash of 2008, didn't the Fed lower and raise rates in order to slow the economy down or speed it up? They raised rates a quarter of a point and our economy slowed down a little. Isn't that what's supposed to happen? Wasn't that the reason why they raised rates? Isn't that always the reason why they raise rates? So the fact that the market backed off and the economy backed off a little, maybe that's what the Fed wanted out of this, right? That is the goal of raising rates. Now, I trade technically only, and technically I'm telling you we're playing follow the leader. The S&P's going down. The bonds are telling you we've erased the rate hike. So if the rate hike isn't what knocked us down, then what is? I say we're in a pullback. It's not the end of the world. The economy and the market are two different things. What does that mean? A lot of education in this video. Jesus. You guys should come to my OMNI camp where I can tell you all this good stuff. All right. So the market and the economy are two different things. Here's how you'll know this right away. More simple. This is going to be a simple example. We have had many, many bull and bear markets since you've been alive, right? Whoever is listening to me right now, think about how long you've been alive. How many bull and bear markets have you seen? How many crashes like 2008 and 1929 have you seen? So the markets are allowed to go up and down without it crashing the economy. If that were not the case, then you'd have to make a point to tell me that the only time the market goes down is when we're having a crash like 1929 or 2008. And that's not the case. Markets fluctuate. Economies don't always stay in lockstep with the market. So our economy is kind of doing really well. The markets are allowed to gyrate without creating a 2008-style crash. I've said this in almost every video for weeks now. The economy and the market are not the same. The market is allowed to come down. It's allowed to have some play without putting us into some sort of a depression. So let's forget about 1929. Let's forget about 2008. These things happened. The crash happened. We get those once in every 5 generations. I mean, think of the time span between 1929, do the math, and 2008. It's not a very difficult thing for you to figure out here, right? That means we're not supposed to see another one of those style crashes until about then. I think you're going to be okay as far as that's concerned. So, let's play the market for what it is. It's going down. We trade it with the red arrow until it starts to go up. Tomorrow we're starting off with no arrow. We'll figure out what it wants to do and we'll attack. The bonds are telling us that the rate hike is back to not being raised and it hasn't brought the market back up yet. Then there's the gold chart masterpiece, traders. You're going to love this gold chart masterpiece. If you like this video, if you like these videos, if you like the charts you're about to see, subscribe to these videos at YouTube so that you'll get an email every time I put out a fresh one. Or just join me live in my chat room. It's free at livewithoscar.com. With no further ado, let's go look at some charts.
I've been following Oscar off and on for about a year, and I decided to come to OMNI Camp because I thought that his calls were very good, and I wanted to learn how to do some analysis on my own.
I've been following Oscar for about 2 years. I took the step because I really like his recommendations, really like his videos, and I guess I wanted to further increase my knowledge. It was like an investment in myself. Big decision for me because it was halfway around the world, but yeah, I'm pleased I made the decision.
I didn't know what to expect. I mean, I knew that Oscar's somebody that really knows what he's doing, really knows what he's talking about, and he's honest. He's not trying to hide anything or disguise anything. He's pretty. The guy that goes out and makes videos every night and tells you what the market's going to do. Nobody else does that, and is accurate with it. That's phenomenal.
My expectations before I came to OMNI Camp were a little uncertain. I felt like it was almost going to be too good to be true that Oscar would open up all his knowledge and share it with us, and in that regard, it far exceeded my expectations.
Yeah, I had some expectations for the OMNI Camp, and I had some goals, personal goals I wanted to achieve by coming here, but it's just blown me out of the water basically. I'm very pleased. I feel I've learned a lot more than I expected, and yeah, I'm just very pleased.
I think I got exactly what I was looking for out of the class. Very educational. I feel empowered right now to be able to go out and call the market.
My biggest regret was not doing this a long time ago. I think if I could have done it all over again, I would have done this 5 years ago. So I wouldn't delay. If you're curious about it at all, if you want to get to be a better technician, it'll be the best money you ever spent.
I think OMNI is the perfect place to be. It will give you the tools to be able to achieve consistency.
I would definitely recommend OMNI Camp. I think it's an important investment in yourself. I think markets nowadays are moving very fast, and it allows you to get some clarity through all of the noise in the markets.
Okay, traders, the Dow Jones Transportation Average weekly bar chart deemed the leader of U.S. indices. This is your 200 bar moving average. This is watched by every fund manager like a hawk across the United States and probably throughout the globe. When you are below it, they are selling rallies. When you are above it, they're buying dips. The leader has gotten below, rallied up to try to test it and could not get above it, and has created what I like to think is called a bear flag. Now again, we know that it's a concept at the moment. Is it a bear flag? Well, we don't know. It sure looks like one. Once it drops lower than it, then we know it is for sure. But we've got keen eyes, and we can see one building. We're just not allowed to give it a name until it names itself. But that looks very much like a bear flag, and if the leader dropped below the 200 bar moving average and created a bear flag, then the followers should do the same. Here's your NASDAQ weekly, a follower, and if you look, here is a bear flag. We've dropped, but the 200 bar moving average is down here. You need to go, whoa, in order to do what the leader did. That's big movement. So if you look, you've seen this chart in many videos, and if you are new, let me show you what this chart is. This is a NASDAQ chart I've used in so many videos, it's countless. And when it was working really well for buying the markets, I was showing that this black average that I have, when you hit it, you bounce up, and NH means new high, you make a new high. Hit the average, new high. And it just happened time after time. So you hit the average, you made a new high. You hit the average, you made a new high. You hit the average, you made a new high. Hit the average, made a new high. Went through the average, but came right back. New high, average, new high, and it just did that. until we got deep below the average. And when we came back, guess what happened? We did not put in the latest new high. No new high. The result was not the same. Since then, and right around here, I did my sugar honey iced tea, we've got a problem video. The market tumbled, broke this average that it's been holding for years, went into a bear flag, which is bearish, and now this should be some form of a target because the leader, which this follows, is down there. So that's my logic behind why I think we are following the leader. And the same thing with the S&P. Weekly chart, same averages, stayed above it and put in new highs. Those umbrellas represent new highs. Every time you hit the average, you put a new high in. Then you broke the average. No new high. I came out with my oh crap video, and I kid you not, the night of that video was here. And the next day, we started to tumble. Now we've made a bear flag, and we've got to come down and at least test this average, which is very far for the ES, and maybe lower. 3 times a charm? I think so. I think after the third hit, we break this, but let's see. Next chart. The DAX, another follower of the United States and the Dow. The transportation average, it doesn't always follow it, but it does quite often, and it has been for quite some time now. An interesting chart in the DAX. This goes all the way back to 2011. We've got a nice support line. Hit it, bounce off the 200 bar moving average, bounce. Hit it again, big bounce. Hit it again, smaller bounce, but you get through it. Now here's the difference. You hit it in 2011 and not again for years till 2014. And you go up, you hit it again in 2015 and smack right into it again very quickly in the same year. And now you're here in 2016 as well. So 2015 it hits it again, and now we're in 2016. It's a weekly chart, don't forget, and it's all over it. So look at the difference in time that it's starting to hit that line now. We're heading towards the average. See, it's speeding up as it's bouncing off the resistance, or the support, I should say. It's going to break it. So very interesting charts here. Then we move on to bonds. Monthly T-bond chart goes back to 1987 here. Remember the crash of 87? A little teeny crash compared to the big one of 2008? I was in the markets for that crash. Let me tell you, that was a very interesting moment in my life, and I remember this very well. Anybody who didn't buy Citibank on that day sure does regret it, right? Who doesn't regret not buying Citibank back then? All right, so 1987, we have this crash. Bonds have been in this channel ever since. And it just stays in the channel, and stays in the channel, and stays in the channel, and stays in the channel. Well, they raised interest rates right about here, and boom, boom, look what we've done. We have now broken out of the top of this channel. Last time it did it, but didn't stay for very long. This time it's staying much higher and moving up, and it did it right after they raised rates. Now remember the teeter-totter. If you've got bonds going like this, that means you've got bonds going up, right? T-bonds. And you've got rates going down. That's the thing here. Rates are heading down if bonds are heading up. Now, which way do you see this chart right now? Heading up, right? So that's the teeter-totter. Rates have to start heading back down organically, even if the Fed wants to keep them up with bonds moving higher. Isn't that interesting? Then we've got this. Chart masterpiece, baby. This is the masterpiece of charts for this week, that's for sure. Gold daily bar, cup and handle. Now we're on the dailies, and I showed this to you countless times, and I said, look at this. The cup and the handle. This was red, not blue at the time, this handle. And I said, cup and handle, I'm calling it. I know that Investors Business Daily likes to make this call on many, many different charts, but it's not real unless you can really, quantify it. So I did. I realized it was an actual cup and handle. I showed it to you, but at the same time I said, look, we've got a cup, we've got a handle, but let's be more realistic, not so nebulous. Let's just call this a bull flag. Yes, that's a cup, and this is a handle. The blue part of the flag's a handle. But what if we just call it a bull flag? So, number one, started with the cup and handle, and that worked. Number two, bull flag breakout. Look where we are now. Number three, above the fund manager's hawkness. They hawked this. They watched this like hawks. Now we're above the 200. Step one, we created the bottom. Step two, we had a pullback for a breakout. Step three, we got above the 200 ball moving average. If gold continues This is what happened in the beginning of when we started to come down in 2008. In 2006, gold was already moving higher. By 2007, gold was really high. By 2008, the market was cracking big time, the stock market. Gold did start off in this form in 2008. Very interesting stuff going on here, kids. Pay attention to the charts. I am the chart whisperer. I will help you understand these charts at livewithoscar.com. So traders, you just seen the OmniCamp video, and those are the charts that I wanted to show you, and you'll learn all of that at OmniCamp. If you want to come down to OmniCamp, come on down to livewithoscar.com and fill out your OmniCamp applications. Now, what's so cool about OmniCamp is this. What I have been doing lately, in between videos for you guys running Omnis 24 hours a day and trying to be a dad sometimes, is I bought a building, and in that building I am creating a specific area. I'm creating an environment. In that environment, it's going to be an OmniCamp where we are housed together for the 4 days, living under the same roof, so that OmniCamp, when you leave, becomes a fraternity between you and the other OmniCamp members. You will actually live together in a very nice place, more like a little resort to hang out in, but instead of being in separate hotels all over the strip, we will be together for the entire 4-day event. How does that sound to you? I have been building it out, working my fingers to the bones. Look at my hands. They're all broken and cracked and beat up, because I'll tell you right now, none of these clowns in Vegas knows how to put in a day's work like me. I'm from back east. I know how to do 12 straight hours without even looking up for lunch. But guys here are a little bit timid. So I got to get my own hands involved, which I know how to do. You know, I grew up rough and tumble. I know how to fix things. So, boy, I've been hurting myself so bad. You got to see what they look like. However, the point is I'm building out a great OmniCamp where we're going to have a fantastic facility to teach you Omniacs how to read the charts I put on these boards. If that sounds exciting to you, the place is almost done. The next OmniCamp will likely be held there. Fill out your applications. All right, traders, that's about it. Remember, one last thing before I go. I like to tell you about certain rules, and I have signs all over my office, all over the place, to remind me of the rules. And with this insane volatility, let me tell you something right now. Sometimes the best trade is no trade at all. If you decide not to trade, that's a decision like buying or selling. You're sidestepping the market. That's okay as long as you've got good reasoning. Like you do a chart analysis, and it looks like the stop is just so big you can never handle it. Sometimes the best trade is no trade at all. Take that rule and remember it, because it will help you. And that's about it, traders. Come on down to livewithoscar.com, and remember, keep your emotions out of trading. One of the best things you can do to help yourselves with trying to keep those emotions at bay, and I know in this environment it is not easy, but try this. Say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Rock and roll traders, livewithoscar.com. I'll see you there. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.